Hey everybody, Jeff Beers here from 40 Finance. Today we're going to look at the FAANG stocks after the recent market dip, the big one that we saw on Christmas Eve, to see where do these stocks stand from a valuation perspective, and is it the right time to buy any of them? So let's jump in. First on our list today is Facebook, which is the F in FAANG. And right now, year to date, Facebook is down from about 185, 190, all the way down to $131 a share. And it has a PE ratio of 19 with a forward PE of 18. Now the issue with Facebook, I think, is not so much about its valuation as all the problems that it's had with privacy concerns and the government getting involved with internet privacy, etc. I think Facebook is at a really great price from a business fundamentals perspective. However, that price does have a catch, and that is, will Facebook be able to continue to grow now that they're under a microscope for privacy and sharing user data, etc.? There's also a sour taste on the street with Facebook as more and more adults learn about how they use data. Of course, Facebook has Instagram and WhatsApp, so they can parlay into those markets a little bit. But at the end of the day, Facebook still draws in some of the most advertising dollars. I think it's pretty safe at this price that you'll see it go up again. And I definitely want to see Facebook's in some of my ETFs that I buy. But as a standalone stock, I'm still a little nervous, not because of the price, but because of upcoming regulations. Next on the list is Amazon, and coming into this year, Amazon traded, looks like about $1,300, something like that. And right now the price when I took this is at $14.20. So it's basically erased almost all of its gains for the year, brought the PE ratio down to about 79, with a forward PE of 53. I think Facebook has a lot of room to grow. It's actually kind of interesting to look at the Yahoo one-year target estimate, which is just kind of a scan of where analysts put it. They have it at $2,100. I think Facebook is going to continue to grow, probably more in the cloud enterprise segment than retail. I think there's still a lot of gains to be had in retail, but customers are getting used to using other stores, and Amazon's delivery service is second to none. Some retailers are going to catch up to that, so I don't see retail as their huge growth story, but I see some of the cloud services, video, web hosting, etc., starting to come up really big, and the profit margins on those services are so large. So I'm bullish on Amazon. I think if you liked Amazon in February, March, April, May, June, then you should definitely like it right now, because the price has come back down to earth. The PE ratio, while still a little high at 80 and a forward of 53, that's a little out of my typical comfort zone, but because Amazon's so popular, there's just a premium to be paid. If you ever wanted to get it on its while it's on its heels, then now is certainly the time. Next up in FAANG stocks is Apple, which I think, quite honestly, I don't own Apple, and I don't own Apple products, although my family does. I'm a big Google guy. But right now, bottom line, Apple stock has got to be one of the best deals available in the stock market at its current price. I missed the one-year chart on this one, but the bottom line, from a PE ratio, you've got a PE ratio of 12, okay? A forward PE ratio of 1050. This stock is dirt cheap. If Apple faces any pressures right now, it's on the China trade front. Because if China takes action against Apple products and potentially bans them or makes them more expensive in the fight against the United States, that's a huge market for Apple to lose. So I think that's the one cautionary tale. But in America, Apple is alive and well. Next year, we're going to see a new breed of smartphones. I'm sure Apple will be in there. Samsung, I know for sure, has one coming out. This was sort of an odd year for cell phones. There just wasn't a lot of momentum in the market. I think it was just sort of ho-hum. So you got 5G and some other things coming out next year. Apple will definitely benefit from that. The bottom line here is it's still a great time to buy Apple. The company's not going anywhere. Get in while you can if you're interested at what is basically rock bottom prices for a growing company. Netflix. Netflix was certainly the darling of the tech stocks in 2017 and even the beginning of 2018. However, you notice that a lot of news about Netflix started to turn against them a little bit after they came out and announced they're spending basically, millions upon millions, maybe even billions of dollars on content creation. So they had more debt piled onto the stock. And I think people finally woke up and said, hey, the fundamentals of Netflix right now are kind of rough, right? High PE, a lot of debt. User acquisition in America is probably reaching its peak. The international markets show a lot of promise. But all that being said, if you believe in Netflix, like I do, I don't own Netflix directly, but I do have it in a couple ETFs. I think Netflix continues to grow slowly over time. And from a purchasing standpoint, if you figure that for the year, it started right about $225 and it's now at $244 with a PE ratio of 87. Looking ahead, PE ratio of 58, you can basically buy Netflix's gains over the past year without having to pay for them, right? Because the stock it went up and then it went back down. So again, just like Amazon, if you liked Netflix in December, in February, in April, then you should love it right now because you can basically inherit the same company who's still doing the same things, but at a much cheaper price. And this is why it is so important to buy your favorite stocks at different times, the sort of dollar cost averaging you hear about. Because this is an opportunity right now to get Netflix potentially at the cheapest you'll see over the next couple of years. I think it'll come out slow in January and February, but if it has any signs of user acquisition growth in the United States and in foreign markets, you can expect it to bump right back up there. So get in now if you're interested. Last in the FAANG stocks is Google. And Google is basically one of my favorite stocks in the stock market. Huge user of their products. As an internet marketer and a digital marketing expert, I'm into Google stuff all the time. And I can tell you that it's invaluable to the way the internet works. So I certainly don't see any decline in Google's market share there. They also have very little exposure to China, not because they don't want to, but because the Chinese government basically won't allow Google to come in and operate in similar ways that it does in the United States. The government is much more controlling about privacy and who has the data about the country's people. So they're kind of blocking Google, and Google finally held their hands up threw their hands up in December and said, you know what, it's not going to work out. We're going to focus on other markets. So no China exposure. If you have China trade fears, Google is completely on the opposite side of that. Current PE ratio of $38, forward PE of 22. Started the year, I'm going to call that about 1050, 1100. Started the year about $1,100, down to 1021 as of today. It's a great deal. On Christmas Eve when they had the dip, I saw it go under $1,000. And the only thing that held me back from buying more was just Christmas time. I got a lot of money going out and not as much money coming in. So I'm going to have to be patient, but I'm definitely going to be looking to add more Google to my portfolio. So the bottom line on these FAANG stocks right now is if you liked any of them earlier in the year, you should really like them now. Their earnings and growth stories have improved since January, but the fluctuations of the stock market has affected their prices. The beautiful thing about all these, they're easily accessible by an ETF. I like the FDN Internet Composite ETF, so that's one place that you can get exposure to almost all these, but there's hundreds. There's hundreds of ETFs that you can buy in at these prices and take advantage of what I'm almost positive will be gains somewhere in the 2019 year and certainly beyond. That's it for today. My name's Jeff Beers. This is the 40 Finance channel. Please subscribe, like the video, share with your friends. We'll see you on the next video.